The purpose of this video is to discuss corporations and how you apply the accounting cycle and bookkeeping techniques to record corporate transactions. All right, so what is a corporation? We think about a corporation is in itself a separate artificial being in the eyes of the government, a separate legal entity. You know, when you think about corporations, many and most well-known companies are corporations today. And typically those big businesses kind of dominate the activity in the U.S. as far as from a business perspective. What are some characteristics of corporations? Again, we know it's a separate legal entity. We know that there are really quite a few number of owners in most cases, especially when you think of a publicly traded corporation. You will have shareholders, and one share of stock will make you an owner. So a corporation can have numerous owners. Remember that whatever you invest is the most you could lose. There's no personal liability of the owners, meaning if I invest $1,000 in General Motors stock, the most I could lose is $1,000 plus my brokerage commissions to buy and sell the stock. They cannot come after my personal assets. There's also a lack of mutual agency, meaning that if I'm a shareholder of General Motors, I cannot make business decisions for them and act on the corporation's behalf. That would be left up to the day-to-day operations and the board of directors who sets the vision for the corporation. As far as indefinite life, pretty much it's going to continue. The business will continue in perpetuity unless otherwise stated. There is some taxation issues. We'll get into that in a little bit. And it definitely is a little easier, in fact, probably a lot easier to raise capital in comparison to other forms of business ownership, since you can sell stock to raise that capital to help the business grow. So we think of advantages and disadvantages. We just said, obviously, corporations can raise more money and probably in a lot easier fashion. It has a continuous life. You can buy and sell shares of stock rather easily on the stock exchanges. Anytime a share is bought and sold, a transfer of ownership in a corporation has occurred. We talked about mutual agency and limited liability. Now, some of the disadvantages, we talked about the taxation issue. Now, corporations are subject to double taxation since the earnings themselves of the corporation are taxed, and when the corporation decides to declare and distribute dividends to its shareholders, those earnings are also taxed for the stockholder on their personal income. So you have two separate times where taxation plays a role. Sometimes ownership and management are sometimes disconnected. You'll see later on in this video where we talk about getting votes for shares of stock, how you elect the board of directors and such. That may not always go according to how people want it to, so there could be some disconnect there. Government regulation is expensive. That's pretty self-explanatory, and obviously startup costs are going to be higher than other business forms. All right, so the different types of things as far as in stockholders' equity that we're going to see in the case of an authorized stock, that's the maximum number of shares a corporation may issue. So once those shares are issued, those in any fashion, they have become issued stock. And then any stock that's held by stockholders is called outstanding stock. So you have different classes there. You have authorized, issued, outstanding. Authorized is always the largest number. You can never have more issued or outstanding shares than the amount of shares that's authorized. Now, sometimes you'll see where stockholders are issued actual stock certificates. Although in the internet age, I think some of that is going down. It's more digital these days than it does with getting paper certificates. And capital stock, where it represents a stockholder's ownership. All right, as far as the voting rights and this would be, let's make a real clear note here as far as that's concerned. let's say this is for common shares. So for each share of common stock that you have, you get 1 vote, and you will get dividends. Now, in some cases, you will see that you have both preferred. You could have preferred and common stock that would issue dividends. We'll talk a lot more about that later on. And then, in the event the business closes and liquidates after all of their liabilities are paid or satisfied in a way that creditors are happy, anything left over, the stockholders would receive their proportionate share of those assets. And then what I like about this is the preemptive right, and that is if they're going to issue more stock, as a stockholder, you have the preemptive right to maintain the exact amount of proportional ownership you already have. So let's say you had 10% of the company shares, and they wanted to issue another, say, 2 million shares. Well, you'd have a right to buy 10% and keep that. Now, you don't have to, but you have that right to be able to either accept and buy the shares or part of them, or deny and not buy any. Again, you can see that we have different types of stock, common and preferred. The one thing that we'll say about preferred stock is that you do not have voting rights. So just that's for common. Now, the thing that you have to also remember is that in most cases, you may see stock having a par value or a no par. You could have no par stock, but in most cases, they do have a par value. And basically, the par value is the arbitrary dollar amount assigned to track the stock for accounting purposes. It does not have anything to do with the actual market value of the stock. It's just a way to track the stock. Now, stated value stock is technically no par stock that has been assigned amount that's similar to par value. To me, stated value and par value are very similar. You may see both of these, but just know that stated value and par value are very similar. We know that the corporation's equity is stockholders' equity. Again, our accounting equation will now change from assets equals liabilities plus owners or partners' equity to assets equals liabilities plus stockholders' equity. So that is our primary accounting equation when we think of a corporation. And we have 2 things that we have to look at as far as where you're going to get the capital from, the stockholders' equity from, and that's paid in capital and retained earnings. Let's go through some of that. We know companies raise capital by issuing stock. We know that a company can sell its stock directly to stockholders, or they can go through the process of being underwritten and having them issue the stock on our behalf on the stock exchange. We know the stock exchange is things like the New York Stock Exchange or the NASDAQ stock market. Those are pretty familiar, hopefully, to you. And remember, the issue price, nothing to do with the par value or stated value of the stock. That would be the amount that the corporation receives from issuing its stock, and that would be from its IPO when it was first born on the exchange, and then going forward you could issue stock at whatever price you wanted to if you wanted to issue more shares. All right, let's talk about a couple new accounts. Let's look at this. We know that we will have, just draw some T accounts here. We know we'll have the common stock account, and that would have a credit balance. And we know we'd also have the preferred stock account in the event that those particular shares of stock, that class of stock, would be offered. again, both would always be having a credit balance. Now here's where we need to be a little careful, because some books do it differently. I try to make it a little easier when I'm teaching it, to make it something you can remember. Remember, we're always going to keep track of stock at par value or stated value, or you may have no par. Well, if it's no par, then it's going to be pretty straightforward. But that's not too common. We might see that a little bit in this class, but not too much. You want to look at par value or stated value, and you're going to have a different type of account. You're going to have an account that's either called something of this nature. We'll kind of block this off here. We're going to have additional paid in capital in excess of par or stated value. Now that sounds like a mouthful, and believe me, it is. So additional paid-in capital in excess of par or stated value. And I refer to that as APIC. Much easier to write and remember. And remember, here we're always trying to think of ways to help us make this easier to learn. So if you had APIC common, you would just list that. APIC preferred, you'd list that. Now, again, you do not have APIC when you have no par. So I say no APIC. Do it like this: no par, therefore no APIC. Now, what type of account is APIC? Well, we can draw that here. Again, that'll be, and it would matter what kind it was, APIC, either common or preferred, would always have a credit balance. It is all of these accounts would be owners' equity accounts, specifically stockholders' equity accounts, and go in the stockholders' equity section of the balance sheet. Now, one other new account that we'll mention here is retained earnings. And you might see that abbreviated R/E. I'll put that here. That's acceptable as well. Now, typically, you would think that it would have a credit balance, and that's typically true. However, let's make the caveat here. Let's put a little asterisk by this thing here and say may have a debit balance in the event that the business is operating at an overall net loss. And this would mean that you'd have what's referred to as a retained earnings deficit. And that's okay, because in many cases, corporations do not generate a net income right away. And you may see that you do have a retained earnings deficit. Now, specifically retained earnings, what really is it? How can we define it? It really is the accumulation of profits and losses and also where dividends are declared. So in that case, what you have to remember here is that retained earnings is going to be where the profits and losses go, and then also where the corporation is going to declare and then subsequently pay, hopefully pay cash dividends or stock dividends. Keep in mind, though, that there is no guarantee that a corporation is ever under any obligation to pay dividends to its shareholders. Now, shareholders might get impatient after a certain amount of time if they're not getting any dividends and the corporation is doing well, that they may decide to sell their shares of stock and go elsewhere. Well, that's a possibility. And again, shareholders may be more patient if a corporation is just getting off the ground and running at a loss. It just really depends on the corporation and if they want to declare and pay dividends or not. All right, so let's look at some problems here together. It says here, the first thing, as an example, is issuing common stock at par value. Smith Corporation issues 17,500 shares of $2 par value common stock at par. We need to record the stock issuance on 1/1/17. All right, so we know that. Let's change colors here. Let's go with all right, so 2017 on 1/1. So let's think about this. We know that we have a par value, and we always have to record our stock at par. So we would take 17,500 and multiply that by $2 par value, and we see that that comes out to be $35,000. So here's what we're going to do. We have to think about what's coming into the business. Well, we know we're going to receive cash, so cash is going to be debited, cash for $35,000. And notice that we sold it for exactly the par value, okay? And we know since we issued it at par, there's not going to be any APIC because there's no difference between the issue price and the par value. So all we have to do in this case is to credit common stock for the $35,000 as well. So again, the nice thing about this is if you have a stock and it has a par value and it's being issued at par value, you know that it's not going to involve any APIC. And then the other situation is if you have no par, you also have no APIC. So we don't have to take too much time in either of those cases. It's a pretty substantial and easy journal entry. All right, let's look at the next example here. Coastal Corporation has two classes of stock, common $4 par and preferred $5 par value. All right, journalize Coastal's issuance of $5,500 shares of common stock for $10 per share. All right, in this case, notice they didn't really give us a date, so we'll just fill in, we'll just keep going with January 1st if they don't give us a date. So notice that this is for common stock, so we don't need to worry at all about the preferred. That's irrelevant to what we're doing here. Now, notice that we have a difference. Par value was $4. The sales price per share was $10. So the sales proceeds, or the amount of cash that's coming in, we're going to debit, will be for 5,500 shares times $10 per share. And that obviously comes out to be $55,000. Now here we are going to see where we have to remember that we record stock at par value or stated value if it has it. In this case, we know it has par value. So let's credit our common stock account. In this case, we will see it's 5,500 shares times $4 per share par. So we know that 5,500 times $4 per share par comes out to be 22,000. Now, we see that we do not have the debits, the total amount of the debits equaling the total amount of the credits. We know that that was going to be the case. We know there is a $6 discrepancy between sales price and par value. So remember, we have to put the rest in APIC. In this case, it's APIC common. And that would be, take the 55 minus the 22, 33,000, or you could still do 5,500 shares times $6 per share. And that would be, we figure that out by taking the $10 sales price minus the $4 for par. $10 minus 4, 6. All right, so that concludes that problem. Let's go to the next part here. Here's something that has dealing with no par common stock. Let's see how we track those entries. Ashford Corporation issued 10,000 shares of no par common stock, again, no par, for $5 a share on March 13th. Record the stock issuance. Again, our rule is no par, therefore no APIC. Very simple. So we know that, okay, looks this is on July 7th, so we'll put 17, 7-7. Think about what are we going to debit, what's coming in. We have cash. Oops, it looks like I accidentally skipped ahead there, so let's regroup here. So it's no par on March 13th. 313. So no par, no APIC. 10,000 shares at $5 a share. So we know cash is coming in of 50,000. And we know there's no par, so there's no APIC. All of that goes directly to common stock. That's our credit for 50,000. All right, now let's see if we can now go to the next one here. It looks like I skipped ahead here. It's writing in that journal, so let's fix that there. All right, so now we're going to deal with stated value. It says Turner Corporation issued 6,500 shares of $3 stated value common stock for $11 per share on July 7th. Record the stock issuance. Okay, so what you have to remember here is that in this case, it's the same treatment except the word par is changed to stated value. It's not any of this. Par value or stated value, it's going to be treated the exact same way except the fact that it's the same process as the other way. All right, so now let's look at this. We have 2017 7-7. So we know we have cash coming in here. Cash, we know we have 6,500 shares times $11 per share. And that's going to be 71,500. And then we notice that we have to record at stated value. So we have common stock. And that's the 6,500 shares times the $3 per share stated value. And we credit that for 19,500. Again, 6,500 shares times 3. And then the rest goes to APIC common, and we know that has a stated value. Additional paid-in capital in excess of stated value. All right, so we have 71,500 minus 19,500, or 6,500 shares times the $8 per share difference, 52,000 would be our credit. Again, nothing different in the process. Only thing you're changing is the word par to stated. We also may run into a circumstance where we have the fact that you could issue stock and receive assets other than cash. Pretty much you could issue stock for anything that you wanted to, as long as both or the multiple parties agreed to it. So let's see what this particular example says. It says Miller Corporation issued 30,000 shares of $1 par value common stock in exchange for a building with a market value of $160,000. Record the issuance of stock. Okay, so we don't have a date on this one, so we'll go to 1-1 again on this. So let's say that we did that, and we see here that it's a $1 par. So what we would do if we are getting some other asset other than cash, we would have to get the market value of that. We do have that, it's 160. So instead of cash, we know we're going to have to debit the building because that's what's coming in to the business. And we would have to credit two things. One, common stock. We know we have to always record at par value. We know it would be 30,000 shares. Times $1 per share par. So that's obviously $30,000. And the remainder goes into APIC common for $130,000. You could also do that by taking the number of shares times the par, taking the 160 directly minus the 30, and getting the $130,000 figure. Alright, so again, this did not involve cash. We involved buying a building by issuing shares. And we can do that. We could buy land, we could buy machinery, equipment, office supplies, pretty much anything that you wanted by issuing stock. Alright. Now, notice here in this particular case, we're going to look at preferred as well as common. It says here Coastal Corporation has two classes of stock. Common $4 par and $5 preferred par value. Okay, we already did this earlier. We did this one previously. Let's look at the second one here. So on 1-1, journalize Coastal's issuance of 5,500 shares of preferred stock for a total of 27,500. Okay, so let's see what we got here. We have cash coming in. We know we have to record the cash for what we got. They told us specifically what that was, 27,500. They didn't have to even do a calculation. They gave us that figure. Then notice here that just happens to be 5,500 shares times 5 is 27,500. So it looks like we issued preferred stock directly for the par value. So we had 5,500 shares times $5 per share par, and that comes out to be 27,500. So if there would have been a higher figure than the 27.5, the remainder of that, let's say if it would have been for 30,000, we would have debited cash for 30, credit preferred stock for 27.5, and then we would have put APIC preferred for the other 2,500. But in this case, we did not, even though we have a par value, we did not have any APIC because we sold it at the same value as par. All right. So this time, it might be a good place for you to take a break here, step away a little bit, maybe do some of the problems referred to as far as the basic stock issuance. I'm going to pause here for a few moments and come back to this, and we'll pick it up with treasury stock. Okay, so now we're back and we can continue on here. Let's talk about treasury stock. First of all, what is treasury stock? Basically, that's when a company buys back its own shares of stock that it had previously issued. So a lot of people ask me questions a lot of times about why a company would want to do that. Well, there are some pretty straightforward reasons. One easy one would be that they want to avoid a takeover, meaning that someone may be considering trying to buy up a controlling amount of shares and then kind of taking over the corporation. So that would be something, you could prevent that from occurring. You could buy back, the corporation could buy back shares to avoid that. You may need employees stock options. So if you're going to reward employees with stock options, you've got to have the shares of stock to give them. So you might need to go out and reacquire some. You also, if you're taking shares and buying them back, you're also going to potentially increase the company's stock price on the stock exchange. So that could be a strategy the company is trying to use. And then obviously, if you could buy the stock as a corporation at a low price and then reissue it again at a higher price, you may be able to increase your cash. So there's some pretty straightforward options of why a corporation would want to do that. So here are a couple things that you have to remember about treasury stock. The treasury stock account is an account that has a debit balance. Here's the key thing, though. It is a contra equity account, meaning that it's opposite of the normal equity balance. So that's why instead of a credit, it has a debit balance. Always record treasury stock at cost. Par value is irrelevant. It has nothing whatsoever to do when you buy treasury stock. You always record it at cost. Nothing to do with par value. And then the key thing, and we'll see an example of this later on as we finish up the presentation, you will see treasury stock subtracted out of the stockholders' equity section of the balance sheet after retained earnings. It is subtracted out because it is a reduction to equity, hence contra equity. The biggest mistake that I see folks make is they think treasury stock is a good thing. Oh, treasury, it may or may not be depending what your strategy is as far as using it, but it's not an asset. Please make sure you realize it is a contra equity account. So, with that being said, here would be how you would set up the T accounts for treasury stock. You would just simply have a T account, and it would be a debit balance because it's a contra equity account. Now you may have APIC treasury stock at some point, and this would just be a regular equity account, and this has to do with if we would buy and then resell the treasury stock. We may have a gain or loss on that transaction, so we could potentially have APIC treasury as a result. So make sure you know that those treasury stock would have a debit balance, contra equity. If you do have APIC treasury stock, it would have a credit balance because it is an equity account. All right, so let's look at a couple transactions here and see how we do with this particular thing. And I've set this up so I will have one journal entry per page here. This will continue on as I move forward. Bottom Dollar Furniture Incorporated completed the following treasury stock transactions in 2016. It gives us December 1st, 15th, and 20th. So let's do December 1st, and again, we'll just stick with this year. Let's change it up a little bit on the color again. Let's go with dark blue. Okay, so on, I will just say 12/1. Purchased 1,800 shares of the company's $1 par value common stock as treasury stock, paying cash of $6 a share. But recall what we said earlier. make sure you always record treasury stock at cost. So, very simple transaction. Par value is not a relevant factor here. We're going to debit treasury stock. And that would just simply be for 1,800 shares times $6 per share. That comes out to be 10,800, and we're going to give them cash that's exiting the business, so we credit cash for 10,800. So in this particular case, we see that we've taken care of December 1st on this particular slide. All right, we'll keep going to December 15th. So let's do this one. We've done this. So this is out of here. We've taken care of that one. Now we're focused on this one. 2017, 12, 15. Now, what has happened here next? Let's look at this. Sold 300 shares of the treasury stock for cash of $9 per share. Okay, so let's look at this here. First thing, we have to think about what's coming into our business. Well, we know we sold it for cash, so we know we're going to have to debit that. Cash. Now, how much cash are we going to have to debit it for? Well, we sold 300 shares times $9 per share. So that would be 2,700. Now, what are we going to get rid of here? We know that we are going to credit and reduce treasury stock. Okay, now remember this. We always have to record it and then sell it back if we sell it again at cost. So let's get it off the books for what we paid for it. So 300 shares times $6 per share. And that comes out to be 1,800. Well, the nice thing in this particular case is, notice, and we can see this pretty clearly, we bought at 6, we sold at 9. So out of the 1,800, we sold 300 at that price. So we're going to have a small amount of difference here. That's going to have to go to APIC treasury stock. And that would just simply be the 300 shares times the difference of $3 per share, and we see that that is $900. So now we have a circumstance that we actually sold the treasury stock. We reissued it basically for more than we bought it back for. That's a good thing. All right, so we now took care of the 15th. Now we can go on to the last piece of this problem. So we've taken care of this. We've taken care of this. Now we have this one to do. All right, so let's do this. 17, 12, 20. Sold 700 shares of the treasury stock for cash of $2 per share. Assume our APIC from treasury stock transactions on December 20th is 2,700. Okay, so let's look at this here. So they're telling us right away, and let's do a little T account up here. Let's try to squeeze it in like right here. APIC treasury stock, we know currently has a credit balance of 2,700. So we have that in there. Now, let's go ahead and do the simple thing first. We know cash is coming in. However, unfortunately, we know that there's not that much cash coming in because we sold the 700 shares at only $2 per share. So we know that that's 1,400. Now, let's think about this for a moment. We know that we paid a cost basis of this. So let's look at this. Treasury stock, we paid $6 per share. So we got to figure out here what that's going to be. So we had $6 a share, and at times 700 shares, we know that we have to get 4,200 of treasury stock off the books. Now, let's explain what happens here. We know that this is not enough to cover it. We have technically, if you look at this, we got cash of 14, but our cost basis again was the 4,200. So you can see there's a difference of $2,800 that we are short in this particular transaction. I apologize, that keeps happening. It's kind of been really jumpy today. All right, so let's see how this is going to work. What the steps are whenever you have a treasury stock transaction and you are short on, you always go to APIC Treasury first. So, do we have any APIC Treasury that we can use? And the answer is yes. We have the 2,700 up here in this T account. So, let's look at this. We are going to exhaust, if we need to, APIC Treasury to help us with this circumstance. Notice that we are 2,800 short. In fact, we need to exhaust all 2,700 there. So let's go ahead and debit and reduce that. APIC Treasury stock, 2,700. So we've exhausted this. Now I debit that. Its balance is now 0. Well, guess what? If we are still short, which in this case we are, we've taken care of 2,700, so we are now $100 short at this point. We need to then take it from retained earnings. So because retained earnings has a credit balance normally, again, it can have a deficit in some cases, but we would, and no matter what the circumstance, we would have to take it from retained earnings. So we have to debit retained earnings for $100, and then we can finally credit our treasury stock for the 42. Again, always at cost. And that we did up there, $6 a share times 700 a share, and that's 4,200. So again, exhaust APIC Treasury first. If there's no APIC Treasury, you have to, or you exhaust it, you go to retained earnings after that if you need to finish it out. All right, continuing on. We then get to what's called a circumstance of dividends and stock splits. And how do we account for those different types of circumstances? Okay, again, we know that we want to reward our stockholders for investing in our company. So it's a common strategy that corporations want to pay back and give them dividends. And again, dividends could also be not just cash, they could be stock, could be other types of property. Now, again, you also may see that a stock split could come into play, and that's a little different than a dividend, and also different from a stock dividend. They are a stock split and a stock dividend are not the same. So we'll see how to account for these things here. As far as cash dividends are concerned, you have 3 different dates that are relevant. First is the date of declaration. That's when the board of directors of the corporation announces the intention to pay the dividend and a liability is created. So on this day, you need to do a journal entry. The second date is the date of record. This is when you must become or already be a stockholder on that date to be able to receive the dividend. In this particular case, there is no journal entry that is required. And finally, the date of payment or the date of distribution. That's when you actually, as a shareholder, receive, the corporation pays you the dividend specifically to you. So obviously, when cash is being paid out, a journal entry would be required. So date of declaration and date of payment or distribution, you need to have a journal entry. On those two dates, as far as data record, you do not. Now, one thing that we have to be very careful of here is when you think of the different types of stock, you could have preferred and common, we know that, and you can also have preferred dividends and common dividends. So the first thing you have to do is you have to look at, if you have preferred stock, is it cumulative or non-cumulative? The thing you have to remember is that preferred stock is always assumed to be cumulative unless it is specified as non-cumulative. Now, what does cumulative versus non-cumulative mean? It means that in the event a preferred shareholder, or really the preferred shareholders, are not paid their dividend, dividends in arrears can start to accumulate. It means that you, as a preferred stockholder, have a right to get your dividend every year, even if the corporation does not declare it. And if it is cumulative, those will consistently add up and must be paid first before common gets anything. So if you have preferred cumulative stock and no dividends for anybody have been paid for 10 years, you are technically owed 10 years of dividends. Now, you may not get it if they never declare. They will just continue to add up. But if any dividend is declared, preferred must be called up first. Now, if it's non-cumulative, you would only get your current year's dividends first, and common would get what's left. So keep that in mind. Now, preferred dividends are calculated by taking the percentage times the par value times the shares outstanding, or a straight dollar value, if that's a characteristic, times the shares outstanding. You may also see a common either get the remaining amount, what's left over, or a specific amount if preferred's already been taken care of. All right, so we have to realize here again, preferred is going to receive cash dividends prior to common shareholders. If dividends in arrears exist, along with current year's dividends, they must be paid prior to the common shareholders receiving any dividends. Common shareholders get whatever dividends, if any, are left. Common dividends, again, are calculated by the number of shares outstanding times the per share cash dividend, or are dictated by whatever remains after paying the preferred dividends. Just to kind of summarize what I just previously said. All right, so let's look at some new accounts here. Basically, you will see a new account called cash dividends. And this is a temporary account. And we will eventually close this out to retained earnings at the end of the period. It would have a debit balance, because it's going to eventually, later on, reduce our retained earnings account. You also have two liability accounts: dividends payable to common and dividends payable to preferred. Both of these are liability accounts. And just like any old liability, they would have credit balances. So those would be the new accounts that we need for our dividends. All right, let's take a look at a problem here. So we see here, French Roast Company earned net income of $95,000 during the year ended December 31st of 2016. On December 15th, French Roast declared the annual cash dividend on its 2% preferred stock of a par value of $128,000 and a 75-cent per share cash dividend on its common stock of 65,000 shares. French Roast then paid the dividends on January 4th of 17. Okay, and they want us to journalize the entry declaring the dividends on December 15th and journalize the entry for French Roast paying the dividends on January 4th. Okay, so let's look at this. Let's do a couple things first. Let's go ahead and do the calculation. We said for preferred, they get paid first. So preferred stock, the dividends are going to be 2% times the number of shares times par. Well, they've already done that calculation as far as the number of shares times par. That's the 128. So I just need to take the 2% times 128,000, and that's going to give me the preferred dividend of $2,560. And then I simply, since they're also going to just dictate specifically what the per share cash dividend is, we're going to take for common $0.75 per share times 65,000 shares, and that comes out to be 48,750. Now we add both of these two things up, and we see total dividends are $51,310. Now we can go ahead and do the journal entries on the next page. So we need to just get them on there. Okay, so let's see what we have here on that. We know that preferred, we just calculated was, we'll write this out so we have the correct numbers in front of us. Preferred was $25.60 and common was $48,750 for a total of $51,310. So, on the first journal entry here, declaring the dividends, date of declaration, so we know this is 16 and this is 12 of 15. We're going to debit our cash dividends account for $51,310 total. And then we will create two separate liabilities where we credit one for dividends payable for preferred, and that was $25.60, and also then credit dividends payable. Let's write that out. For common, $48,750. So that would take care of declaring the cash dividends on 12/15 of 16. And then the second entry here, we'd simply have to pay it. And we would do that by, let's see, looks like I need to create a different thing. Let me pause here a moment. I need to create something here for this. I'll be right back to you. All right, so my apologies there. We needed to add another journal area here for the second journal entry. Now we're in 2017 and we're on January 4th. All right, so now we know that we have to just pay off those liabilities. We would have to debit on the date of payment, debit dividends payable for preferred, 25. $25.60. We debit dividends payable for common for $48,750, and we're going to credit and give them cash for $51,310. So that takes care of that particular problem there. All right, moving forward, what is a stock dividend? A stock dividend is a little different from the perspective of we're going to have to think of not giving out cash, but issuing new shares as a dividend. So, think about this. No cash is going to be involved. Only accounts associated with stockholders' equity will be impacted. It will not have any effect on total stockholders' equity. And again, no assets or liabilities will be impacted. So let's see how this works. Why would we want to do this? Again, we still might want to give our stockholders some type of dividend, but we just might not have enough cash on hand to do something like that right now, so we'll just give them some stock dividends, conserve our cash. We also may want to reduce the market price of our share of stock. Maybe our shares of stock are really trading at a real high price. If we lower the price, maybe more investors could come in because it wouldn't be as expensive. And then we also may want to just reward investors, again, with a different way instead of giving them cash. Again, 3 dates for stock dividend, just like we had for cash dividends: date of declaration, date of record, and date of distribution. And again, we need journal entries here. No journal entry here. And we will need a journal entry here. Now, the interesting thing about this next piece is that if you notice, there's going to be a small gray area, but I'm going to eliminate that so you understand. So you have 2 different types of stock dividends, small or large. For this class purposes and for my, as far as teaching perspective, small stock dividends are going to be less than or equal to 20%. So we're not going to worry about less than anything greater than 20 to 25. Okay, so we're going to get rid of this. So really just cross out this, and we're going to put less than or equal to 20%. Large stock dividend in this class is going to be greater than or equal to 25% of issued and outstanding stock. So notice that nothing's going to fall between 20 and 25. We're just going to leave that as a gray area. It'll either be less than or equal to 20 or greater than or equal to 25. So small, 20% or less. Large, 25% or more. Greenview Water Sports has 16,000 shares of $1 par value common stock outstanding. Greenview distributes a 5% stock dividend when the market value of its stock is $25 a share. All right, we need to look at this, I'd say, a little bit more in depth. Let me see here. Let's try to get some accounts on here, new accounts here. as far as this is concerned. Again, I think I'm going to put a new account slide on here. I'll be right back. Okay, so let's look at the accounts we're going to need for recording stock dividends. Okay, let's do this. Let's change it up here a little bit again. Let's go here. All right, so we're going to go with our first D account. We have stock dividends. And this will have and be another contra equity account that we have here. Again, debit balance for a contra equity, opposite of equity, which would be a debit. And then we have another account here, an equity account, common stock dividend distributable with a credit balance. It is equity. Now, one thing we have to remember here is what are the rules. So let's break it down. So when you have a small stock dividend, again, we are talking about less than or equal to 20%. Always record at market value. When you have a large stock dividend, which is greater than or equal to 25%, we said, and then we will always record at par value. So, rule of thumb, small, record at market, large, record at par, and you will use these accounts in either process. So back to our problem that we were starting a moment ago. Again, we'll go over that again. Greenview Water Sports, 16,000 shares of $1 par value common stock outstanding. They distribute a 5% stock dividend when the market value of the stock is $25 a share. So we know this is 5%, so we know that that is a small stock dividend that we're dealing with. We know that we have to record at market. So we know that the $25 a share will come into play. First thing you have to do is calculate the new number of shares. We start out with 16,000 shares. We have to multiply it by the 5% stock dividend that they're going to do. And we know that we have to come out with 800 new shares. Now, we know it's a small stock dividend. To record it, we have to multiply it by the market value, $25 per share. So our total value of the stock dividend from a monetary perspective is going to be $20,000. So on 8/15 we need to declare it, and 8/31 we need to distribute it. So in the interest of space, I'm going to start right here. I'm going to debit stock dividends for $20,000. Now, how do we record stock? Always at par. So in this case, common stock dividend distributable number of shares that were new was 800 times par, which was $1. So it's $800 and the rest goes to APIC common. And that would be 19,200. Now, the stock is not yet distributed. It will be distributed on 8/31. Very easy transaction to do there. We just need to debit common stock $800 and just credit good old regular common stock. So again, small stock dividend at market value. Okay, let's look at the opposite of that. That would be a large stock dividend. Billy Incorporated had 270,000 shares of $2 par value common stock issued and outstanding as of December 15th of 16. Company is authorized to issue 1.5 million common shares. On 12/15 of 16, they declared a 40%. So we know what that's going to mean. Stock dividend when the market value for Billy's common stock was $7 a share. The stock was issued on December 30th. Journalize the declaration of distribution of stock dividend and how many shares of common stock are outstanding after the dividend. Okay, we know right away 40% means that it's a large stock dividend. So we know it's 40%. So we know we need to record at par value. This market value thing right here has nothing whatsoever to do with this problem because we need to record at par value. Calculate the new number of shares, 270,000 shares that were outstanding, multiplied by 40% stock dividend. New shares are 108,000. And we simply have to multiply that by par value. That would be $2 per share par value. And we know that we need to value this at 216,000. Very easy journal entries here. 12/15, same as before. We still will debit stock dividends. $216,000. We just calculated that. And we credit our common stock dividend distributable. $216,000. Now, hopefully you're not asking why is there no APIC? Well, because we record at what? At equal to par, so in that case there is no APIC. And then we simply on 12/30 would debit the common stock dividend distributable. $216. And credit our common stock. All right, moving along to the next topic, we have stock splits. Again, I said before, this is not the same as stock dividend. It is basically something that's not going to require a whole lot of work. What's going to happen here is the stock split's going to increase the number of shares that are issued and outstanding, And it's also going to either decrease the par value of the market value, but it does not affect the par value overall from a stock dividend perspective. So think about this. Stock dividends, no par value effect. Stock split will change that, but overall total value of the stock account will not change. Let's take a look and see how this works. So let's say that on the left side here, you have common stock, $1 par value, 3.15 million shares issued and outstanding. Well, we always take par times shares issued. Notice that we get what? 3.15 million. Well, let's say that they want to do a stock split. They want to do a 2-for-1. 2-for-1 stock split. You may see it written like this. Okay? Well, in this case, what's happened? The number of shares from this one here, this first slide here, to here has now what? Number of shares has doubled. 3.15 million times 2 is 6,300,000. But what happened to par value? Par value has been divided by 2. In this case, $1 par divided by 2 would be 50 cents. So we know 50 cents times 6.3 million is the same 3,150,000 as $1 times 3.15 million. So you have to see nothing really changes as far as a value is concerned from overall stockholders' equity. But what the hope is, let's say this, your market value is also probably going to be cut in about half. So let's say the market value was $10. Well, now it's going to go down to $5. Well, now what we hope is if the company continues to do well, the stock price will continually go up. Well, let's say 2 months later, the stock is now $7 a share. Well, guess what? You had double the number of shares now from a market value perspective and might be able to gain by selling your shares of stock from that perspective. But on the books of the company, nothing really occurs except par is decreased, shares are increased, but the total value of the stock account is the same. So what has to be done in the journal? Nothing except a memorandum entry. All you have to do in the journal would be to note the significant event, but there would be no debit or credit amount. So technically there really isn't a specific journal entry, it's just a memo in the journal to record the stock split. Just a couple things about financial statements. You'll see a corporate income statement. It's very similar to the multi-step income statement for merchandising. Remember, you'll have net sales minus your cost of goods sold is your gross profit. And then you'll have all of your operating expenses. Just know that you'll also have income tax expense on here because corporations are required to do that. Again, we run into the double taxation. Corporations will be charged tax, and then the dividends will be taxed by the individual shareholder. And so just keep in mind that you will see a breakdown of taxes on the corporate income statement. We also don't have really a statement of owner's equity. We have a statement of retained earnings. Well, in this particular case, basically, you're going to have to check and figure out what is the retained earnings balance. And there really is a formula, and I'll show that to you in a moment. And you're going to want to calculate this and have a separate statement. And remember, again, at the beginning, we can have a negative retained earnings or run a retained earnings deficit if the company has not turned a profit. So let's look at this and see how this is going to work. Tinder Incorporated had beginning retained earnings of $90,000 on January 1st of 16. During the year, Tinder declared and paid $90,000 of cash dividends and earned $95,000 of net income. Okay, so what we want to do here is we need to prepare the statement of retained earnings for Tinder year ending December 31st of 16. Okay, so remember base. Back to, and this could be something you could have learned back in Accounting 101 or a different bookkeeping class you may have taken. remember base. So let's see how this is going to work here. So we're going to start with the beginning balance of retained earnings. And the beginning balance of retained earnings, the B in base, would be $90,000. You're going to have two sections, one where you're going to add stuff and one where you're going to subtract stuff potentially. And then that will yield to us our ending balance of retained earnings. So B, A, S, E, right up here. So follow that along. So we're going to add any net income that we might have, and notice that we did have net income, so we're going to add net income of $95,000. Now, we also would have to subtract net loss, but we didn't have that here. You can only have net income or net loss. You can't have both, so we had net income in this case. But we also have to remember and not forget, this is a common mistake a lot of times, we can't forget to subtract out any dividends that we paid. So we would say subtract out dividends. So in this case, we would have a circumstance where we had 90,000 of dividends too. Subtract them out. So this actually comes out to be a pretty simple transaction. 90 plus 95 minus the 90 is simply ending balance of 95,000. So again, remember base, beginning, add, subtract, ending, add net income or subtract net loss, and don't forget to subtract dividends if you have that. One other thing I want to kind of go through real quick is the stockholders' equity section of the balance sheet. Notice here that we have one listed here from the text. And I just want to make sure everyone understands this. Notice that the paid-in capital consists of your stocks and your APICs. And that would include if you had preferred stock, you had APIC, preferred, APIC, common, APIC, and you notice we have treasury stock. So you would include all of those things. Add them all. Now, how do we break this down? Notice that if you look at this, $1 times 8,092,120 shares is $8,092,120. We take that, we add this, the APIC common, we add APIC treasury stock, that equals total paid in capital. We then add in retained earnings, we then subtract. Notice this is a subtraction, treasury stock at cost, and that equals your total stockholders' equity. So make sure you're going to be asked to construct some of these, so you may want to pay particular attention to some of this here, and that should help guide you through when you're doing some of those. A couple other notes here, not too much as far as problems, just kind of notations. Just know that sometimes you may have cash required of cash dividends and treasury stock purposes. You may need to separate those accordingly. And in some cases, banks may often require you to maintain a certain level of stockholders' equity. And as a result, you may have to do what's called appropriate retained earnings. And that means that you're going to place restrictions on those funds, and you would do that by journal entries. In some cases, if you have a mistake and you have to go back and fix something that's material, you may have to address that, make a correction, and do what's called a prior period adjustment. Again, this is going to be for material errors that that really would significantly impact the overall financial position of the company. Let's say if you made a $7 error and you're a billion-dollar company, well, you're not going to worry about redoing all your financial statements for that. Now, if it was a $7 million error, that would be something different, and you would have to go back and do a prior period adjustment for that. A couple ratios that we look at for comparing other potential investments across the board. So you could look at earnings per share, you could look at rate of return on common stock, and price earnings ratio. And they're basically listed here, very simple. You would actually, on the income statement, the multi-step income statement for a corporation, you would actually have their earnings per share broken down specifically on that financial statement. And the way that you calculate that is you take net income, you subtract out preferred dividends, and divide that by the average number of common shares outstanding. So it's a pretty straightforward formula. All these ratios are not overly difficult. Just kind of follow along with the formula. As far as your price earnings ratio, you need to use your earnings per share, and basically this is telling you how much investors would be willing to pay for $1 of a company's earnings. So you simply just take your market price per share, which you have to be given or look up. If it was a publicly traded company, you could find it on the stock exchange easily, divided by your earnings per share. And finally, we have rate of return on common stock. So how really, when you think about it, what is the net income and the relationship to that when you think of what common shareholders are investing in the business? So the formula for that would simply be net income minus preferred dividends divided by average common stockholders' equity. Now, what you want to remember here is make sure that you know that some of these formulas we will see in more detail later on. I just want to make sure that you're familiar with them. You may run into a couple of these being asked of you in some of the problems that you may see. All right, this completes this particular video on corporations. Again, thanks to Horngren's Accounting for helping me adapt these PowerPoints to produce this video. Next chapter, we'll look at other corporate issues.